Okay, guys, we're going to get started here with chapter 15. We did 14 last week, and I want to get you in 15. We are fast running out of time, guys, and I want to get you through chapter 15 at least, but I'm having to really prioritize what I'm teaching you. We may not get to chapter 16, even though that's my goal. We've got to do the income statement this week for the merchandising corporation we've been working with. And this is a little more complex. It's a little and more intensive than the income statement we did in chapter 7. Now, the major sections, we've still got our revenue section, we still got our expenses section, we still got our net income section and our header here, but we've got some additional things we need to calculate. We've got to deal with chapter 9 and 10, which is buying and selling on credit. We've got uncollectible accounts we need to deal with. We need to deal with our merchandise purchases, our purchases account and our sales accounts. We need to look at all of the additional expenses we have, plus depreciation on our durable goods. We've also got to deal with salaries because we never had payroll before. And then we've also got to deal with our federal income tax that we just got done in 14.6. Now, we're going to do the balance sheet, and we got to do the statement of changes to stockholder equity next time. But 15.2 is the section where we're dealing with analyzing this document. And this is where we calculate earnings per share as well as price to earnings ratio. I'm not going to assign that to you simply because I need to keep this workload manageable for you, but I am going to walk you through it today after we get done with preparing the income statement. I'm going to post the materials and I'm going to post a second assignment this week, but the analyzing the income statement assignment is an optional assignment. My goal, though, is to at least expose you to it so that your college professor is not getting a blank look from you when he teaches you this at the next level. At least you know what your professor's talking about. So let's jump right in here. We've got some additional sections we got to go through, and this is going to be a little bit labor intensive, so I want to expedite as much as possible. Okay, I'm going to start by working out of the book at this point, and let me go find it. Okay, here we are, chapter 15. So our learning objectives for this are to primarily prepare an income statement for a merchandising business organized as a corporation. Okay. We're also going to prepare an income statement we're going to analyze it using component percentages and financial ratios. You've heard this stuff before. The rest of the chapter, we're going to deal with the stockholder equity statement as well as the balance sheet. These are a little more straightforward. It's the income statement we got to kind of grind through. We got some new terms that I want to talk about. I've included the relevant sections from the text here to go through. Now, adequate disclosure, again, we need to report enough so that an external party, a lender, a stockholder, potentially a board of directors member, or a government auditor could come in and see, hey, we're above board. So that's adequate disclosure. The other concept here is consistent reporting, meaning that if we do it one way, we need to try to do it the same way year after year after year. We can change the way that we do it, but in our annual statements that we're publishing, because we are a public corporation here, we've got to indicate that, yeah, we made the accounting change, and we've got to openly and transparently disclose the reasons why. And we've got to provide a comparative analysis using the old method and the new method optimally. Okay. Here's our ethics lesson. I miss not being able to teach this stuff to you guys, but we just don't have the luxury of time. So, okay, here's our worksheet that we finalized in the last chapter, chapter 14. So we're going to be using our Hobby Shack worksheet. And what we've got to do here is we've got to report something called cost of goods sold, or cost of merchandise sold. You'll see it reported as cost of merchandise or cost of goods. We have bought things to resell. The difference between what we paid for it and what we sold it for is our gross profit. That's literally the definition of gross profit. So it's the difference. It's the markup. You'll see this as markup. You'll see this as profit margin. And then, we talked a little bit about stuff like contribution margin, which is variable expenses and fixed expenses and how they play into it last year or 2 years ago. That's exactly what we're talking about here. So we're talking about that difference, but we've got to account for all of our purchases as well as the value of our existing merchandise inventory. So what we have here on our corporate statement are the same section. So the revenue section, which starts at top, but it's broken down into additional detail. The cost of merchandise sold section, which deals with the value of our start of year, beginning of year, January 1st inventory, and our ending inventory on December 31st. The December 31st closing inventory is our starting inventory for next year. So we got to get it right because we're going to use it next year. And finally, we've got a breakdown of our expenses, and we've got all of our additional expenses like our cash short and over, our tax liabilities, our payroll taxes, our salary expense, all of that we've done in chapters 12 and 13. So we need to account for them as well, meaning everything that we show here on our worksheet, we've got to do some number crunching for. Okay, this is not overly complex. It's just there's a lot of it. It's a big basket. So I'm just going to real quick go through this. The example is here in the book, and I'm going to touch on the PowerPoint in a little bit. So we set up our income statement, who, what, and when. Always start with the header. That's section 1 of every financial statement. Section 1 of all financial statements is who, what, and when. Okay, then we label revenue section, and we start with sales. Okay, now this works the same way that the financial statements in Chapter 7 do. We don't have debits and credits here. What we are doing is we are working from high levels of detail to aggregation. This is summary data here in this third column from the left. Okay, so we have sales. We've got one revenue stream, and the sum of our sales was looks like $95,000. Okay, but remember we had sales discounts. We were cleaning out our inventory, moving the stuff out, offering discounts to people who bought in bulk or for paying early. That's what this is. And then our our customers return stuff to us. So we've got to value that in. So these are contra accounts to our sales accounts. And what we do here is the sum of all sales. We want to know that. We want to know what our maximum sales were for the year. Then we have to subtract things that reduce our total amount of sales. Why not do that up front? Well, I don't want to do that. I want to know exactly how much I did sell, and I want to know how much I had to give people their money back for. So this is why it's tracked. Sales discounts, how much stuff did I unload? How much did my customers take advantage of the discounts? How much stuff did I sell on sale? That's what I want to know here. And then I want to know how much stuff I got back because it was faulty or it got damaged in shipping, whatever. We sum that. So this minus this equals our net sales. So literally net sales is an accounting term. And whenever you see that, it is your absolute top tier total sales minus the value of any contra accounts that reduce the value of those sales. In our case, it is sales discounts and sales returns and allowances. So our net sales were $491,000. Okay, that's the first section. So the instructions for doing that are right here. You can walk down these step by step by step. I'll show you in the PowerPoint. This is very, very self-explanatory. Here's your example. Follow this step by step. And again, I'm moving through this quickly because my last video to you guys was an hour, and I don't want this one to be an hour. Okay, next section. Okay, so now we've got to do the cost of merchandise sold. This is section 2. I'm trying to find my camera here. 2. Section 2. Section 1 is revenue. Section 2 is cost of merchandise sold or cost of goods sold. I use cost of goods sold just because it's what I'm used to. So cost of goods sold is literally, okay, so cost of merchandise sold is a separate section header. And then what we do is we enter the starting value of our inventory 364 days ago, January 1st of the current fiscal year, which is, let's just say it's 2020. So we'd be entering the value of all of our goods in our warehouse here on the 1st of January. That's our starting point. So again, that's aggregation. So we put that in column 3. Purchases. Remember our purchases count from, chapter 9? Yeah, long time ago, right? So our purchases journal, which is used when we buy merchandise for resale. right? Remember that? Yeah, that's where we're entering the value here. So we spent $209,960 on new merchandise between the period January 1st to December 31st. Okay, but we bought stuff on sale. We want to do that. Okay, it makes our profit margin higher if we can get stuff cheaper because we can sell it for roughly the same price, or maybe we pass it on to our good customers a little bit. But we want to buy on sale. I'm a cheapskate. I'm always looking for a sale. So, but then we also have to deal with merchandise that we return because it came damaged when we receive it from our suppliers. So we return stuff. All right. So basically, we spent a total of $209,960, but we returned looks like $5,133.10. So our net that we spent on merchandise for resale was actually $204,826.90. Okay. Guys with me so far? I'm going to make this a little bigger so I can read it. Okay. So our net purchases, meaning our net purchases for resale of our inventory, is $204,826.90. So the total cost of merchandise available for sale. This one you guys struggle with for about a minute. So what we are doing here is we start with the value of our existing inventory we already had, and then we add to it the total value of everything we bought new between January 1st and December 31st. So this is the total amount of inventory we had to sell, and this is what we paid for it. Okay? So that's what we had. That's what it cost us to buy it. And, if you ever get into value of inventory and you're talking last in, first out, or first in, first out, or whatever method you do for inventory accounting, this number becomes critical because there are times when how you sell the inventory becomes important. A hammer is a hammer. Okay, a hammer made in the 1990s is the same as a hammer made today. You can sell it. It doesn't matter. First in, you sell that. An iPhone, that iPhone 1 in 2007 is garbage. It's a paperweight. You may have somebody collect it for collector value, but you're going to want first in, last in, first out when you're talking about technology. So it does matter. Okay. Now, so our merchandise inventory, this is what we had at the end of the year. So on December 31st, when we did our end of year inventory that everybody hates doing, this is what we came up with. So we had a net drawdown of our inventory compared to the year. So that's generally indicative that we had a good year. Businesses like to see that. They don't like to see this number increase year to year. Okay. So we ended up with a net decrease in our value of our existing inventory. It's not sitting on our shelves. We're turning it over. We're getting it out there. We're using it to make money. That's a good thing. So the total amount that we had starting plus the amount that we bought equals, and then minus the amount we have right now sitting on our shelves in our warehouse here on December 31st equals. So this is the total cost of merchandise sold. This is what we paid for everything that we sold through the course of the year. Now think about this. This is a lot more efficient to do than trying to figure out what on earth every single item costs. It isn't going to work that way. So what we do as an accounting process is sum the value of everything we had plus everything we bought minus everything still on the shelves equals. Okay, this is the cost of everything we sold. This is what we paid for. It's not that hard. You just got to walk through the steps. Use your example when you do this. Okay? So our accounting concept here is the concept of historical cost. And again, it tells you right here, cost of goods sold or cost of sales. You'll see this COGS or COS in a lot of cases. Again, I use COGS just because it's what I'm used to in one of my earlier lives when I was dealing with Simon & Schuster. And one of the things we did was resell their products, which is educational text as well as digital products. And I had to do the inventory, and I hated it just as much as everybody else does. But cost of goods sold is what I used back then. So next. Let's scroll down here. All right. Now, we have to look at net sales and net purchases, okay? So we got our sales. We've already figured this out. Again, look at this where this is. Make sure you got a line here. Okay, we're dealing with these three columns. And again, if we have a number here next to the bottom on an account, we know that this line, this here, because it has a line under it, is the sum of these two. So you got to look at the logic. You're working from top to bottom, left to right on this sheet. So what this indicates here, and I know I fussy you guys about your lines and I take points off, this is where it becomes absolutely essential to have these single rule lines here. This single line tells us this plus this equals this, and then we move over here because we know, because there's a single line under here, that this is a mathematical operation, this minus this, okay? You got to have it in there in order to be able to interpret this. Whoops. All right, let's go back. Okay, so those are our two sections. So we got the revenue section and we got the cost of goods sold section. We've calculated our net sales. We've calculated the total cost of our merchandise sold. We've run the math. Okay, so we now know what our net sales are. Okay, we now know what our gross profit is. So now what we do is we got to go back to our net sales. Okay, we've got them here. So our sales minus the value of all of our contract counts equals our net sales. Now we're jumping into component percentages here. Remember from last year, our sales is the denominator in all of our component percentage calculations. So we know this one's going to be 100%. Okay, just kind of jumping forward here. Now, what we have to do is bump up the cost of goods sold from our net sales. So we're going to calculate our gross profit. Literally, it's a simple calculation where we've got the total cost of merchandise, total cost of goods sold here. So this, the net sales that we calculated minus the cost of goods sold, now equals gross profit on sales. So if you ever see gross profit on sales, your mind should immediately go to, okay, net revenue minus cost of goods sold equals net. Boom. That's your primary profit margin. All right. So we know right now that our cost of merchandise sold is 44.9% of sales, which leaves our gross profit 55.1. Again, this plus this should equals this. It's that simple. Okay. It's that simple. We literally have, you add these two together, you're going to get 100. And that's the way it should be. All right. So this here, this 55.1% of our net sales is what we have left. Okay, this is what we have left to cover our other expenses. So we go through and we now look at our fixed expenses and our variable expenses. And we simply break those down. This is the easy part. We go back to our worksheet, we look at our expenses section, and we just start plugging in numbers. Add expense, cash short and over. Remember, our cashiers can't count. Okay, and we're shortchanging the Girl Scouts when they come selling cookies. All right. Then we got a credit card fee expense. Yeah, credit cards providers are going to charge you a percentage of every sale, and they're going to charge you a monthly fee for the privilege of taking the credit card. But remember, you as the merchandiser want to encourage people to use the credit card because they always spend more than if they're paying cash. Yeah, we want to do that. But we want to track to see how much we're spending because we want to play one provider against the other and see if we can get a better rate somewhere. PayPal is expensive. It's convenient. It's easy to set up for the small business owner, but you will probably want to go through your bank if you're a large retailer. They'll cut you a break. All right. Then we've got a depreciation expense. So this is the value that has been lost on our durable inventory over the course of our 12-month period. January 1st to December 31st, we depreciated our office equipment and our store equipment by the sums here. Now, this is summary data. It's everything that's classified as office and store. So this is how much less it's worth because it's got another year of wear and tear on it. Then we got our insurance expense. Okay, this is how much we reduced our insurance policies. You know, you can break it down if you want. In the real world, with payroll, you're going to have all your employee benefits policies that you've got to pay for. They're going to be classified as individual expenses. You're going to have your vehicle insurance. You're going to have your physical building, your physical plant insurance. You're going to have insurance hazard insurance. You're going to have workers' compensation insurance. All of those are going to be itemized in the real world. But for here, we're just going to roll them up into an insurance expense. Okay. Then we got our payroll taxes. Okay. This is what we paid in payroll taxes. All right. Then we got our rent expense. Rent's expensive. We may want to consider building. Interest rates are really, really low right now. Mortgage rates are 3% because the real estate market is dead. It has been dead since we've been locked down. So maybe right now we look at it buy versus build. Maybe we build. Maybe we buy something instead of renting. It's an asset. Okay. Then we look at the value of all of our supplies. We got to get our salary in there. Okay. Once again, salary is the number one cost to all businesses. Employees are expensive, but we want to treat them well. We want to give them a fair compensation and benefits package because we want the best and the brightest talent working for us. But we got to make it cost effective. We can't price ourselves out of business. So there you have market equilibrium coming into play when it comes to salary and benefits. What can you afford versus what do you need? And you got to find a tipping point. You got to remember, the labor market's competitive. People are talented. The best people are going to be extremely expensive. The folks at the bottom of the spectrum, if you're just paying them the minimum wage, well, that's what you are going to get. You're going to get that bottom rung employee or the completely inexperienced employee that you've got to spend a lot of money training. So you as the employer spend a lot of time setting prices and doing research on what a good employee should cost you. Take the time to do it. It'll save you headaches in the long run. Okay, then we've got our uncollectible accounts expense. This is money that's owed to us from our customers that we're never going to collect on. Customer may have gone out of business. They may have skipped the country. Hopefully it wasn't with your accountants and your money, but there's a percentage we're never going to be able to collect. So this reduces our profitability. So finally, our utilities. How do we keep the lights on? Do we want to build a cogen plant and burn up some of the waste that we have? Something to think about. Okay, and then we sum them. So here's our total expenses. So the sum of all our variable and fixed expenses is 33.9% of our net sales. Okay, so what's that leave? What's that leave as our gross margin? Well, sorry, our net income. 21.2%. So for every dollar we make, we actually get to keep 21.2 cents. For retail, this isn't horrible, but think about this. Think about really thin margins like a grocery store where you got a really thin margin here on your inventory, your primary inventory, your milk, your bread, your eggs, your potato chips. You're looking at 2, 4, 5% maybe. Okay. Where do you make your money? Well, you make it on magazines. You make it on party supplies. You make it on the soda in the cooler on the way out the door. That's $2. Okay. That's where you make your real money. Okay. So your net income before federal income tax. Remember, we went through on the worksheet and calculated this. Okay. We had to calculate it and then go back and enter it as an expense and then recalculate it for afterwards. Yeah. That's what we're doing here. We're plugging those numbers back in. So net income before, and then we plug in our total income tax expense from January 1st through the 31st, including our last quarterly payment, which was an additional $52, if I remember correctly, beyond what we estimated. We've gotten good at this. Okay. So our net income after federal income tax, what we get to keep, our net profit, the bottom line, ladies and gentlemen, right here. This is the bottom line. Okay. It's $80,000. And where are we? Ah, shoot. Lost the effectiveness. So I'm going to go back here and start over again on this. Okay. I really wanted to get to chapter 17, 18, and 19 this year, but didn't happen. Okay. 15.1, out of the $495,000 in sales and our gross profit, our net profit is $80,000. Think about that. Okay. About 20% is all. But that's after all our salaries have been met. That's after all of our people have been paid. That's after all of our expenses. That means we paid all of our bills, we paid for all of our merchandise, we paid for all of our suppliers, and we have $80,000 left over. So what are we going to do with that? How are we going to spend that $80,000? I want to look at it again here. That's what we got left. This is what we sold. This is our net sales. This is what we spent on inventory making that money. Here's the sum of all of our expenses, $166,000 plus our inventory. And what we got left after we paid taxes on our net income, which was $104,000. Think about that, okay? The net income we had to pay taxes on was 20% of our sales. Think about that. Okay, and then we had an effective tax rate, if I remember, of about 22.3% on what we paid here based on the progressive tax structure, that is the corporate tax rate. We ended up with $80,000 left. Seems like an awful lot of work to me. But here we are, gross profit on sales. Okay, so we got a components percentages. Now what we're doing again here is we are dividing these by this dollar figure, okay? Just give you an idea. So that's how you prepare the income statement. And I know we're getting kind of long here. Here's the steps in aggregate in the book for preparing it. And again, here's our component percentage breakdown. This is very, very useful here in the book. It's on page 453. Look at this. Take a look at these percentages, and it runs the math, okay? It tells you how to do it, and it tells you how to construct these percentages, okay? So if you add this plus this, it should equal this. That's a hint. And this plus this should equal 100%. Everybody with me? Okay. So I'm going to go down. All right, so what we've got here is the work together problem. I'm long-winded, so I'm not going to bother to go over the PowerPoint with you. It's posted for your consumption. Okay, but we're going to go through. I'm going to go to ACCIII and do this. So we're going to prepare an income statement for Interstate Tires. We're going to record the net sales, the cost of merchandise sold, gross profit, total expenses, and net income before federal income tax. And we're going to round our percentages. Remember, when you're doing the component percent, use one decimal point to the right of the decimal. Not 2, not 0. It has to be 1, exactly 1, or else it's wrong. Okay? It has to be 1. That's the convention for this. So I'm going to bounce over to ACCIII here, and hopefully it's still signed in. Okay, good. All right, maybe I'm going to speed through it. I pre-filled this. You're going to have to set this up. You're going to have to start with the headings here. And the way this is set up, you want to indent everything that's not a heading. ACCIII won't let me do it, which is another reason why I won't let you use it, because it doesn't do it right. But here's the expenses section. And we've got total expenses down here, salary expense. We've got our net income section, okay? So what we want to do is go ahead and start plugging in the numbers. So I'm just going to walk through this. So we've got our $548,989.25, okay? Remember here, this is the sum, everything we got. So 548, 89.25. Now, sales discount. Okay, how much should we sell on sale? Well, you got to go to your ledgers here, but the information is provided. You got 2 pages of worksheet that you got to go through. Work from your worksheet, work from your general ledgers if you need to go back that far. Then we got our sales returns and allowances. So it looks like 35.12.84. Now remember what we're doing here. We got a line here, and what we're going to do is we're going to add this plus this, and we're going to plug in that number here. So 41. 74.53 is our sum. Okay, got another line here. Then we're going to run math. So this minus this equals this. And we end up with $544,814.72. And we know our component percentage is going to be 100% because it always is. component percentage for sales is always 100% because it's 544,814.72 divided by 544,814.72. So, merchandise inventory. The starting value of our merchandise inventory on January 1st of the current fiscal year is $198,480.33. Okay. Purchases. This is what we spent buying new inventory. So we got $278,452.39. So that's new inventory we bought during the period January 1st to December 31st. So what did we buy on sale? $184,845.78, I believe. Okay, and what did we return? What did we send back? So we sent back $3,548.65 worth. Okay, so this is what we spent. This is what we returned. I think I've got too much money in here. 1,845. All right. Yeah, that's better. So we should have $5,394.43 that we sent back. Okay, so what we then need to do, remember this is a sum, this minus this equals the total amount that we actually spent on buying new inventory. So we're coming up with $273,000, $273,057.96 if this looks right. Okay, this is what we started with. This is what we bought new. So we're then, again, we got a proof here. So this plus this is the total cost of all the merchandise we had available to sell during the fiscal year January 1st through December 31st. So 471, 538, 29. Okay, so this is a simple addition. This plus this equals this. Now you're starting to see why I fuss at you guys so hard about the single lines and the double lines. This sheet becomes unintelligible without these. This tells you how to actually interpret it and prepare it. All right. So, and this, less merchandise inventory. This is what we had sitting on the shelves at the end of the year. So $188,999.25 worth of goods left. So, hey, we reduced our inventory by about $10,000. Not horrible, not great, not horrible. So then we're going to run the math. Everything we had to sell minus what we got left, this should indicate the total cost of everything we purchased to resell that we actually did sell during the course of the year. So we're looking at $282,000, $539 and 4 cents. My math is right. 282, 539.04. Okay, and then we then put this in the numerator, this in the denominator, and we come up with 53.9% component percentage for our cost of goods sold. Okay, so our cost of goods sold is 53.9% of our net sales. Scrolling down, we're blowing through this pretty well, guys. So what's our gross profit on sales? Well, that's easy. This minus this minus this now equals this number, $262,000, $275.68. Okay, well, so we put this on top of this, do the math, and we end up with 48.1%. Okay, so the proof is, if this plus this equals this, we know we did it right. So this is our gross profit. Okay, so net sales minus cost of goods sold equals gross profit. So our expenses, we're just going to plug in our expenses. So for advertising, we spent $9,320. It looks like. Cash short and over. Yeah, we only ripped off the Girl Scouts for about $1 Girl Scout cookies. Credit card fees, we got off pretty easily if you want to run the math on what percentage of this. You know what? I actually have never done that. I'm going to run this real fast. I want to see what percentage our credit card company is gouging us. So we had 544,000. I'm going to use net sales because anytime we receive a refund, we get refunded on the fee for the credit card. Okay, that's just the way it works. If it doesn't, you need to look at your contract and you need to yell at your provider. So 544,800. Yeah, let's do this backwards. So 9454.45 divided by 544.72 equals. So we got a pretty screaming rate on our credit card fees. We're only getting charged about 1.74%. That's pretty good. Most companies are going to get charged about 2.3%. So we got a screaming deal on our credit card sales. So pretty good provider here. All right, so depreciation. We're drawing down our office furniture. 4260. Yeah, just look at the chairs in my lab. You see how banged up they get? Thankfully, I don't have to do the depreciation on that. Store equipment, 5750. Okay, insurance expense. Got 6,000 if I'm looking at that right. Miscellaneous expense, check fees, whatever. That's miscellaneous. Payroll tax expense, 9315. 66. Okay. Rent, that's a big one. Rent is not that horrible, but still, we're looking at $1,500 a month. Okay. Salary expense. This is our biggie, 102,576. Okay. Then we got our supplies office that we bought. Again, I'm just going down here and I'm just plugging in using the worksheet. Now, I fussed you guys pretty hard about using the alphabetical character to cross-reference. This is where it really becomes important because it's easy to get off track when you're looking at the expense section here. So again, there's a reason I fussed you guys about doing it a particular way. And there's a reason that I got to the point where I was taking points off about it, because this is why right here. It's very, very difficult if you haven't done your worksheet properly and you haven't set up your background research properly. So that's why you do it the way you do it. It's not just because I'm being finicky and mean. That's just a bonus to me. Ha ha ha. Okay, so our total expenses here. What did I forget? Okay, I'm off track here. I did something incorrectly. 1680. All right, didn't take it. So 64.87.89. Okay, total expenses. So we got $184,000. 184,764. Okay, run the math. This is your numerator. This is your denominator. We get 33.9%. Our expenses are 33.9% of our net sales. That's what this means. So net income before federal income tax is simply, well, it's an easy number. We're subtracting this here, which is our gross profit. We're starting with this, subtracting our total expenses from our gross profit, and that leaves us with $77,511. 14 cents. Okay. That's what we got to pay income taxes on. So we got a 14.2% bottom line margin. Okay. That's starting to get thin, isn't it? Then we got to pay taxes on it. So we ended up paying $14,603.79. I want to run the math to see what the effective tax rate was on that too. Okay. So we got 14,000. 603.79 divided by 77.11, 14. So our effective tax rate was 18.8%. Okay, so our net income is simply this minus this equals, and we end up with $62,907.35 to do with what we will. So, do we want to distribute earnings to our shareholders? I think they probably want a piece of the pie. Okay, but that's after tax. All right. So we now got to worry about our dividends. We got to decide whether we're going to retain these earnings. Yeah. Or whether we are going to distribute them, or we're going to get our board of directors to get together and we're going to make a decision about what percentage of this we want to reinvest in the business, because that's what we're talking about here. Whether we want to pay out bonuses to our executives, how much we want to distribute in earnings, what our earnings per share are actually going to be. Yeah. Okay. That's what we're doing. So I'm going to move into that, and we're just going to jump into it real fast. So I'm going to pull up 15.2 here, and I'm going to run through this. So we're going to analyze our income statement, which the goal here is to assess the financial condition and operating results of the company. We're going to analyze the financial statements. We're going to interpret them. We're going to run a little math. So I'm going to bounce back to the book. This is here for you to look at. But the thing is, we're going to look at component ratios for each of the four sections, which we just calculated. The big piece of this is I want you to know how to calculate the earnings per share and the PE ratio. Okay, so we need to look at both a net company's got net income or net loss, and then what earnings per share and what the P/E ratio are. So four major component ratios on the income statement are, what are they? Net sales, cost of goods sold. Let's see, we just did it. We got our gross profit, we got our net profit, and then we've got our net income after federal income taxes. So those are the four that we calculated. Okay. All right. So financial ratios. Okay. This is what we're talking about. Now, when you're doing stock analysis to buy, you're literally looking at stuff like key ratio, earnings per share, price to earnings ratio. But these are two that'll give you a general feel for how the company's doing compared to any other company out there. How do you do it? Well, okay. There's vocab. Look at it at your leisure. So here's our income statement for a company with a net loss. All right. I'm going to pull the book back up. Component percentages. Now, these are considered to be acceptable component percentages. This is what the industry as a whole is doing. So you as a manager of whatever type, owner, frontline manager, supervisor, you want to know how you are doing compared to everybody else in the industry. Okay, you want to know whether your component percentages are higher or lower. Now, by that self, it doesn't mean anything. Okay, if your cost of goods sold is lower, that's a good thing. If your gross profit is lower, that's not a good thing. If your total expenses are higher, that's definitely not a good thing. But if your net income is higher, that is a good thing. So you got to be able to interpret this in context. Keep that in mind. Again, I'm moving real fast. Okay, so this is an analysis piece in the book. I want you to read through the text, and I want you to just get your thought processes working. This is the managerial accounting piece of it, and this is the problem-solving piece. This is what managers do all day. They find ways to reduce costs, increase income, and improve a margin. Okay, how good you are is as a manager is how good you are at doing this, and that's what financial managers do all day. They crunch numbers, they do what we're doing here, and then they figure out ways to make the numbers better. All right. So here's our income statement. Again, this would have been an in-class exercise we would have gone through. I'm not going to make you do it here, but I want you to do the financial ratios. Okay, the financial ratios is a comparison between two items. Earnings per share. Okay, now earnings per share is calculated by dividing the net income after federal income taxes by the number of shares we have outstanding. This is very simple math. What's the bottom line? Net income. What do we have left over? What's the end by the number of shares outstanding? Okay? This is very, very easy. It's literally earnings per number of shares outstanding. So think about this. When you're thinking about why a company want to buy back some of its own stock, what does that do to the earnings per share? It increases it for the shareholders that own it, that are non-company shareholders. The company owns its own stock. The reason, if it has excess income that it uses to buy back shares of its own stock, is to increase the earnings per share. Now, if you increase the earnings per share of a stock, what does that do to the stock price? Well, it makes it more attractive. If it's more attractive, if you're getting paid more per share for simply owning that share of stock, are you more inclined to buy it? So what does that do? It increases the share price in the market. It's a very, very slick managerial tactic to actually improve the market position of the company and increase the price per share, which increases the value of the company. Okay, think about that. So what you want when you are looking at earnings per share and you are looking to compare one company to another, you want this to be high. This is very attractive to an investor. If it's high, you are interested in it. If it's low, maybe not so much. Okay. Now, the second thing you've got to do is look at the earnings per share. Okay. In order to calculate the price to earnings ratio. So you got to do EPS before you do P&E ratio. So P&E is a really nice tool in that allows you to compare companies' performance that are not operating in the same space. So you can compare a petroleum production company to a retail organization to a tech firm using the P&E ratio. And you can get an idea of which one is the better investment. This is an index. It normalizes the performance of the company. Okay, so P&E ratio is you take the market price of the share, you divide it by earnings per share that you just calculated here, and you get an index. Okay, but the lower this is, the more attractive this is. So this is 100, and I'm seeing you at 10.7. I'm going to buy this because that means I get a better return on my investment. My return on investment is higher the lower the price to earnings ratio is. So this tells me, all right, well, oil has been messed up. It's up and down and all over the place recently. Tech has been up and down, extremely volatile. The only thing that's really doing okay, that's been stable, is stuff that's locally sourced, like Domino's Pizza. Take a look at Domino's. Take a look at Chipotle recently. It's amazing how they have maintained their value when the bottom fell out of just about every other major sector. Okay, take a look at that. Take a look at insurance as well. Why do you think Geico's giving money back right now on auto insurance? Because nobody's driving, because they don't have any claims to pay. So what does that happens to the earnings per share? Well, means if they're not paying claim, they've got less claims expense they've got to pay, which increases the bottom line, increases both the gross margin and the net margin. Okay, which does the same thing to the price to earnings ratio. Okay, if you look at this stuff, wow, nobody's really booking Carnival Cruises or United Airlines unless they absolutely have to. So those companies, the price to earning ratios are very high and the earnings per share are underwater at this point. Okay, literally they're negative, which means the company is not paying dividends right now. But if you want to go buy something and look for that buy opportunity, this tells you right now, based on what Q2 is looking like, where your buy opportunities are. And then you can go and play with some of the more sophisticated ones. These two right here will let you make an educated decision. Okay, so this is very straightforward, and I want to go through the exercise here real fast with you. Again, this is optional. I'd like you to do it, but I'm not going to hold your feet to the fire on this one because I promised you I was going to give you exactly one assignment per week, and that's 15-1. 15-2 is optional. Let's bang this one out real fast. So back to my course outline. And we're going to go in here. Okay. This was a college level class. We would have covered this in a semester, guys. But you're high school, and I can't expect you to operate at the same pace. But just to give you an idea of what college is going to be like, what we did this year is what you're going to do in a semester starting next year. Except for you, River. I got you for another year. So 15.2 work together. Let's go through this. This is very, very, very straightforward. So what we've got here is we got our cost of merchandise sold. Our acceptable component percentage is 53 according to the industry trade. You go to a trade organization, that's why you're a member. They give you this stuff. You can go out and find it, but the reason you pay to be part of that and share your information with your competitors is because they share it with you. This is why Apple and Microsoft play together. This is why Google plays with Facebook, okay? Because they're in it to help one another, even though they're competitive. It's monopolistic competition is what it is. They're big players in the market, but they share information and they compete by fine-tuning their various products to niche markets. And that's where they play. That's their space, and nobody else can enter it because they will stomp you out of existence. They're so big. Okay, so our actual component percentage for our cost of merchandise sold is 51.9. That's acceptable. That's less than what the industry is paying for. So we are spending less money as a percentage of our sales, of our net sales, than our competitors are doing. That's pretty solid. Okay, so that's good. And wants a check mark there, so that's fine. So our gross profit, which remember is our net sales minus the cost of goods sold, is 48.1. So it's above what the acceptable component percentage would pay, which is 47. So we're doing daggone good here. We're doing all right. Do we need to do anything? Yeah, we don't. We could do something. I'm always going to be looking for ways to find cheaper sources. Okay, I'm going to be looking at that. So our net income is $62,907.35. Okay, that's our net income. Now, how many shares do we have outstanding? Well, we have 110,000 shares. Now, pay attention to the shares. We're going to need that because I am going to do the statement of changes to owner's equity or shareholder equity here with you next time. All right, pay attention to this. This is going to be important. And there's one tricky part about the number of shares outstanding that we're going to need to look at. So this is simple math. So what's our earning per share? Well, it's very, very simple. You divide this by this, and you get 57 cents a share. Okay, not too shabby. Okay, so the market price per share, it's currently trading at $13.75 on the New York Stock Exchange. All right, so what we do is we take our earnings per share and plug that in here. So we got our 57 cents. We got our 57 cents. Okay, so we divide the price per share by the earnings per share, and we get a P/E ratio of 24.1. All right. So, compared to our last company at 10.7, this is not as attractive as our other company, which is 10.7. But this gives you an idea of where our company is performing compared to another company in another industry sector. So that's how you do it, guys. This is very simple, but I want you to be familiar with the concept of earnings per share and price to earnings ratio and know how to calculate them. So take a look at it, view it, even if you don't actually submit it. So guys, I'll schedule a Zoom meeting. I'll communicate that out next week and get that scheduled. And that's what I got. Thanks. Appreciate it.